So when you look at the associate, who is an associate? First, to just help you, if you look at the parent, is an entity that has significant control.
Yes.
Whereas an associate will have significant influence, and I'll explain this. So if an entity owns between 20 I would say to about maybe 49, somewhere there. Anything above 20, but where this particular entity has between 20 and 50% stake in a particular company, that entity is going to be regarded as an associate. So to be an associate, you have significant influence, but not control. And we'll go into the nitty-gritties, the elements that actually qualifies an entity to have significant influence. Some few years back, Yvonne, we used to be told that there was a first lady then who had a lot of significant influence in even just picking who becomes the ambassador, who becomes this and that. May not have the significant control, but had the significant influence. And I will explain what that means. Significant control, it is where this entity has greater than 50%. If you have greater than 50%, then you will be regarded as a parent company. Hello?
Yeah, I'm there.
So what is significant influence? What is significant influence? When I look at significant influence, this is basically the power to participate to participate in the financial and operating policy decisions. So if this entity B, that bought more than 20% interest or stake, but less than 50%, this entity, if it is an associate, it will have the power to participate in the financial and operating policy decisions of the company. It does not have significant control. It does not have the biggest voice, that this voice, when it actually rules on a certain thing, and that thing goes. But you participate in the financial and operating policy decisions of that particular entity, and that is very key.
Okay.
So let's just look at the ingredients that would give an investor significant influence. One, representation on the board. Representation on the board, that is very key, Yvonne. So representation on the board. We saw it when Mandela became the president of South Africa. What Mandela did was, because South Africa at that point, at the time that Mandela was becoming president, South Africa was highly divided. There was a racial divide. But even just beyond the racial divide, there was also ethnic divide. So Mandela looked at it and said, it does not make sense to rule a divided country. So he brought all these others, even the people from a racial, who were actually racially different from him, who were fighting him, were brought into that government so that they can represent their voice. It doesn't matter whether it was the majority or the minority. Even the minority groups were included in there, was to give them that significant voice, to have significant influence in the policy direction of South Africa. So looking at it from that angle, We are actually saying an associate, you are not the big boss, you are not the big man. You do not have significant control, but yes, you have significant influence because you sit on that board and your voice is heard. It might be ignored, but it is heard. So you are part of that team that decides the policy direction of the company. So representation on the board is one of that element. Second, participation in policy decisions process. Participation in policy decision process. So I've always said it, that if you are looking at even just to coming up with a good constitution as a country, regardless what type of country that you have, you can still just hire 2 brilliant lawyers and they'll still come up with a very good constitution. Whether by Googling, going to the University of Google to Google some materials from other countries who have a better constitution, they'll do that. But there is a reason, Yvonne, why you involve all stakeholders, the citizens, to participate so that they can own the process. And that is significant influence on its own. Because you have given them the platform to be part of the policy decision of your country, meaning that you are regarding them as a significant influence. They have significant influence. So participation in policy decision process, that is very key. If you're an associate, you participate, you'll be given that platform. You may not have significant control, but you have the influence. So we go to 3. Material transactions between 2 entities. Material transaction between 2 entities. For example, you have company A here, company B there. There are some material transactions that are done by these 2 companies. This other company So these are actually associates. And between the two, there are material transactions. So this relationship, it means that for company B, for example, who in this case has more than 20% shares, but there are all these other items that we look at, that company is able to transact with the other company. That material transaction is one of the sweeteners of significant influence. That's number 3. Number 4, which I've seen in the company that I work for, this part, yeah, which is interchange of managerial personnel. So interchange of managerial personnel is equally key, because if you are able to, you as a company that has invested about 25% shares in the other company, and you are able to take your best brains to this other company to work for this company, because there's this interchange of managerial personnel, meaning that you have significant influence.
Yes.
5, provision of essential technical information. Provision of essential technical information. That is also very key. Okay. So then now we go to, we'll be looking at another segment. So let's look at some few adjustments. This is more of a recap of what you have looked at when you are studying financial reporting. We'll need these adjustments. We'll need this knowledge to do the complex consolidated accounts.
Okay.
So adjustments, group, and subsidiary. So adjustments, group, and subsidiary.
Okay.
One thing that we need to appreciate, these group accounts, they actually take the principles, they draw from the principles of marriage. We are told that when a husband and when a man and a woman marry off each other, maybe that's the right term, I don't know, they become one.
Yes.
So if you have this company where you have the subsidiary company is trading with the parent company, any interest dealings in there have to be cancelled because the principle is that you are one. So
Yes.
we'll look at intra-company balances.
Okay.
So on intra-company balances, the first thing that we'll do, we have to remove payable. Just type, right, remove payable, remove the payable. We are canceling out the payable. Remove the receivable. I'll explain. Here we are saying, say the parent company sold goods on credit. Sold goods on credit to the parent company, sold goods on credit to the subsidiary.
Okay.
At say 500 kwacha. Remember that it is the parent company that consolidates.
Yes.
So in the books of the parent company, in the books of P, that 500 kwacha is a receivable. Whereas in the book of the subsidiary company, that 500 kwacha has to be paid to, is owed to the parent company, meaning that it is a payable.
It's a payable.
Now, drawing from the life principles of a husband and a wife, who then become one because you are consolidating, meaning that these two numbers have to be cancelled.
Yes. Mm.
Right? Okay. Then now we can then go to cash in transit. Let's see how we can treat cash in transit. So what happens with this cash in transit? Maybe nowadays, because of technology, companies may not have this problem, but I know they are still there. Where this company uh, cashes in, maybe actually cashes in a check.
Mm.
Or maybe it's a bank transfer that they have paid the 500 kwacha.
Mm.
The subsidiary has paid the 500 kwacha. But that 500 kwacha on the side of the parent company, the parent company hasn't yet reflected. So the parent company will not assume that this has been paid. We will still show that it's still a payable, it's still a receivable. And yet the subsidiary company has actually canceled that particular obligations because they have paid. It is
Yes.
just that it is still in transit. Maybe with the modernization of this world, these principles will start changing a bit, but I still think even in the real world, we still have these aspects of cash in transit because it doesn't just reflect just at that point. It might take a day or so for it to reflect. So what we do when we are dealing with cash in transit, let's start with step one. So you first adjust the payables because who has actually paid is you adjust the receivables. You adjust the receiver's books, the one that is receiving.
Okay. Okay.
Oh, now.
Adjusted the receiver's books to assume they have recorded the cash. That's what you do first. To assume they have received the cash or they have recorded the cash. So that's the first thing that you do. You adjust the receiver's books to assume they have recorded the cash, meaning they have received the cash, even when they haven't received the cash. Because the fact is that it is still in transit. From the other side, from the one that is giving, we have already seen that it has gone. So what you do with step one, you first assume that they have received. So adjust the books for the receiver. Step two, remove the intra-company. So here, basically removing the receivables. So remove the intra-company. receivable, and payable. Remember the first thing that you did, step one was to first assume that the cash has been received because you can't cancel out cash.
Mm-hmm.
Then the second thing that you do, you remove now the receivables, the intra-company receivable and payable. That is what you do. So you cancel them out. So it's almost similar principle to inventory in transit. It's possible that parent company has bought these materials from the subsidiary company, but they are shown their way coming from Livingston to Lusaka. You cannot record those inventory before you receive them. So they are still in transit. But the one that has given them out, the subsidiary, has already shown that they have sold. So let's go to another scenario, which is basically on inventory in transit.
Okay.
So we start with step one. So deal with the cash in transit. Looks like real. Deal with the cash in transit. Sorry. Let me do this. Let me just delete this. Because we are looking at inventory. So we'll look at which account do we debit. So if it's inventory in transit, that entity that is receiving the inventory that is still on its way, what do? We debit. So we'll debit inventory. So this inventory, you'll find it in the statement of financial position. Which is basically the balance sheet.
Okay.
So then we have actually assumed that this company that is supposed to receive the materials has received the materials. That's the first assumption. So we debit we debit the inventory account. But then here, obvious assumption is that the inventory is being bought on credit basis. So we are going to credit the payables. So the company that is actually buying, that is buying will show that obligation. So we'll credit the payables.
Payables.
You understand the principle here, right?
Yes.
So we debit inventory, we credit the payables.
Payables.
Now we'll go to another concept,
Okay.
a very interesting concept, which is basically, maybe we talk about this principle first.
Come and say good night.
If these two companies, the parent company and the subsidiary company, are trading, there's intra-trade, meaning that there's a possibility of profits to be recorded, or losses, profits to be recorded. Sorry. So if there's a possibility, as long as there's intra-dealing, meaning that this company, the subsidiary company, if it's the one that is selling goods at above cost to the parent company, selling goods, sell goods to the parent company, the subsidiary company, as long as it's selling these goods at above cost, meaning that it is going to record profits. But then, here, the question is, the goods that have been bought, maybe I'll say scenario one. Let's try to create some scenarios to understand the concept well.
Okay.
So first we say S sold goods at a profit. Sold goods at a profit to parent company. So S1, sorry, scenario number one. Did P sell all the goods it bought Did P sell all the goods it bought from S? So in scenario one, what is expected of S? S recorded profits in its books. In its books, immediately its sword goes to who? Immediately its sword goes
Okay.
to P.
P.
Immediately its sword goes to P. It's recorded. It recorded the profit. But then we are saying, since we are looking at scenario one, now we are now answering scenario one. Suppose there is a possibility that all the goods bought from S were not sold. Were not sold to the outside world. All the goods bought from S were not sold to the outside world. So then it means that at consolidation, so it means that at consolidation, S's profits were unrealized. Had P sold these goods to the outside world, S's profits was going to be realized. Are you getting me, Yvonne?
Yes, sir.
So, whatever goods, if say P sold 50% of the goods that were bought from S to the outside world, then it means that 50% of the profits that S had recorded should be reclassified as unrealized profits. So now we are actually coming up with what you call PUP, provision of unrealized profits.
Okay.
So we'll start with the inventory PUP. This is the first thing that we're going to look at. Provision for unrealized profits. That's what that PUP means. So we are saying here, remove intra group profits. Remove intra-group profits included, and I'll explain it by using numbers, included in inventory. In inventory held at year end. Held at year end. So let me explain this.
Okay.
So we say P bought goods at 100 kwacha from S which costed S 90 kwacha. So we go back to this. We are saying any intra-group profits, including inventory held at the end, should be removed. So, meaning that in P's books, inventory has increased by 100 kwacha, hasn't it?
Yes.
Has increased by 100 kwacha. Whatever inventory that he had, plus this inventory that he bought from S, or the inventory that was bought from S, has increased the inventory levels to 100 kwacha.
Okay.
S again, S made a profit of how much? A profit of 10 kwacha. Remember that it costed S 90 kwacha. So made a profit of 10 kwacha. So there is unrealized profit there's unrealized profit of 10 kwacha.
Yes.
There's unrealized profit of 10 kwacha, which needs to be removed from that inventory. From this inventory, this inventory here, we need to remove 10 kwacha.
Okay.
This is what we are going to do. Because P, the value of that inventory has a component of what is regarded as profits. But because this inventory wasn't actually sold to the outside world, that profit was not realized.
Yes.
So we have to remove that. So what is the double entry? We are saying credit, whatever, then we are going to debit whatever to start with. So we'll say credit inventory by that PAP, the annualized profit, or should we say the intra profit, intra trade profits?
Okay.
That's 10 kwacha.
Mm-hmm.
Then we are actually going to credit retained earnings. This inventory, obviously, it is in the balance sheet. Then we are going to credit to debit retained earnings. By debiting, we are reducing retained earnings. Of who?
Okay.
Of the subsidiary.
Mm-hmm.
Who, in this case, the subsidiary is the seller. By that 10 kwacha, which is basically this. 1 or 10 kwacha there.
Okay.
So if you are looking at that table, remember the working two table where it is assets in the subsidiary. Remember that we normally start with working one, which is the group structure. We go to working two, which is the assets in the subsidiary. We go to working three, which is actually goodwill computations. We go to working four, which is NCI. Then we go to group retained earnings. Then we go to other components of equity. So
Okay.
I'll finish the pages, imagine. So I have to find another paper. I finished from my whiteboard. What do I do now? Okay, I'll just write down here. My book is complete. So I say, if seller if S is seller, if S is seller, adjust working two. In that table, we have to adjust it. If it is the subsidiary, that is the seller. Remember that we have three columns, which is the report date, at acquisition, and post. Then we show retained earnings. So that retained earnings has to be adjusted. Adjust working two. If it is P, then we have to adjust the group retained earnings. If it is P, who is the seller, adjust group retained earnings. Oh, sorry. Adjust working 5. Remember that this working 2 is net assets in the subsidiaries. Net assets in S. Whereas working 5 is group retained earnings.
Okay.
Okay. We have to find some space somewhere. You understand this part?
Yes.
Okay, let's just create this. I've run out of book, the electronic book. Still on the PAP, on realized profits, another thing that we should see, it's possible that these companies, the parent company, the subsidiary company, can do some intra sales, maybe on the non-current assets.
Okay.
So, still the same thing. Non-current asset, PAP. So, here again, any profit that has been done, so we'll say remove, this will be the bracket statement, remove the intra-group profit, so you're removing the intra-group profits on the company that has it transferred, the company that has bought that. So you remove that profit. So if it's the parent company that has bought the assets, let's remove that component, because meaning that the cost, the parent company, it is actually valuing that particular asset based on what the price that was pegged to by the price that was pegged by the subsidiary company. So we have to remove that. It's a similar principle that we looked at. Then, so what do you credit? You credit the property, plant, and equipment. So you credit that by that intra-group profits, then you debit retained earnings. Still the same thing. So if S is the seller, so if S is the seller, if S is the seller, adjust working tool.
Okay.
Adjust working tool. Remember that on that, the S would have shown that they made a profit on retained earnings would have actually gone up under S. So this is why you're actually reducing. But if it is P, the seller, adjust working for.
Okay.
Working 5, sorry, on group retained earnings. Any questions up to this level?
I think it's okay.
So we meet on Thursday to finalize
Okay.
on these straightforward group accounts before we start looking at complex group accounts.
Okay.
So
Okay, thank you.
Thank you so much.
Okay.
And bye-bye.
Okay, fine. Good night.